Hey, what's up YouTube? This is Leo with DRIPCalc.com, and in this video I want to talk about one of my favorite stocks. It is Palantir, ticker PLTR. So the stock has been on a tear this year. You can see it is up and to the right. It is almost up to its all-time high of about $36, and I think soon we will get there. Now obviously we'll probably have some bumps along the road, but we're going there. All right guys, so two things before we begin real quick. Number one, none of this what I'm showing in this video is a financial advice. I am not financial advisor. The stock can crash at any moment and you can lose a lot of money. So don't follow me. Don't do anything what I tell you. This is for informational purposes and entertainment only. With that said, guys, so we just went over 400 subscribers. So thank you to everyone who subscribed. And if you're not a subscriber yet, please smash that like button, subscribe to the channel. It really helps the the YouTube algorithm to show more of my videos, and I'll be more excited to make more interesting videos like this. With that, big thanks to everyone, and let's begin. So the stock is up 90.5% year to date, and a lot of people are buying in and FOMOing in. And in this video, I want to talk about how to own this stock for less money, and I also want to talk about leap options on this stock. So anyway, let's begin. So let's break it into two parts. First of all, how to get it cheaper. Okay. So a lot of people are FOMOing, which means fear of missing out. They see the stock is running up and they're afraid they will go to $35, maybe $40, and they want to secure a certain price level, so they're buying in. However, and I've had this happen to me. I've been holding this stock for some time, and so I feel the FOMO a little bit, but not as much as new investors in this stock, especially that my position is now I have it in several brokerages, but my average cost is $16 in one of them, $18 in another of them, and like $23 in other brokerage, but that's before any calls and puts that I've been selling all along, and so my actual average is below $20 on all of them. Anyway, so you might feel like the stock is running away and you gotta own it now before it reaches $40, $50. And even without going into how expensive the stock is, and it is expensive, guys. If you look over here, even at the last earnings, which were amazing, the PE on the stock was 107, and now it's trading at almost like 200 PE. It also depends how you calculate PE, because there is forward PE, there's trailing 12 months. But anyway, the stock is doing amazing. You can see here they've been losing money for some time, but they became profitable in Q4 of last year, or actually 2022. So for 7 quarters now they've been posting GAAP profitability, and the stock holders, the shareholders, are being rewarded for that. And you can see free cash flow is even better for the stock. The revenue growth is amazing. Last quarter was 27%, albeit it's compared against a year ago. And so over here, the revenue growth was kind of slow. But anyway, now it's, accelerating. 27% revenue growth year over year is amazing. Profitability is also amazing. You can see, I mean, this is just insane. 376%. But again, we're comparing this to a year ago quarter when net income was 1.2 cents per share, and now it's 5.6. Now that's EPS, GAAP EPS. Non-GAAP is like 9 cents. Anyway, so the company is doing great, and because people, think they might not catch the train on time, they will FOMO in by 32. Over here it was almost $33. So how can you buy this stock for less money? Okay, one of the strategies is, okay, so I actually had to enable options trading because this is my Roth IRA account with Robinhood. But anyway, so if you want to get a cheaper price on the stock, let's say you want a particular price. For example, you don't want to pay more than $29 for the share of this stock. So what you can do, one of the strategies, is you can sell a put. So a put option is basically you agree to buy the stock for a certain price until the expiration. And here you can change expiration date. Let's say until September 20th, you agree to buy the stock for a certain price. Okay, now once you sell a put, you are obligated to buy the stock if the person buying your put wants you to buy it. Okay, it's their prerogative. So you just collect a premium. For example, you want $29, so right here, a month away, so today is August 21st, a put option for $29. So that's you would collect right now, no, 29.5. So your cost would actually be 28.80 right here. Okay, and you can basically sell a put. You click here. Now I'm not going to sell it because I only have $103 in this account. But basically, you agree to buy 100 shares. Now the option contracts are for 100 shares each. So you agree to buy 100 shares of Palantir for $29.50 until expiration, which is September 20th. Okay, and for that, you collect a premium of about $68. Okay, now you can actually collect probably more, about 69, even maybe 70. But if shares of Palantir drop to say $26, you're still obligated to buy it for $29. But again, the question is, do you agree to buy it for $29? If in your mind you're ready to buy 100 shares of Palantir for $32 right now, you would be getting a $3 discount. So that's about 10% discount from where you're sitting right now. Now, yes, the price is $29.50, but you're collecting about 70 cents or 70 cents per share or $70 per contract in premiums. So that's basically your reward for agreeing to buy shares of this stock in the future. And there is a good chance this will expire worthless, and you actually will not buy. You will not be forced to buy these shares. However, if the Palantir shares drop, and there is, like I said, you don't always have to chase the stock and fall into the FOMO. There will be times when the stock drops, and I'll show you that in a second. But basically, this way you can buy 100 shares of the stock for $29, actually $28.80. That's your break even. That's the actual right here, $28.80. That would be your cost because you're collecting $70 up front, or 69. Anyway, so if you do not want to pay $29, you think, well, maybe right now it's high, it will drop lower, you can sell a $28.80 put. Okay, 28.5 put. Also a month away, you will collect $46 right now per contract, and then it would be, your price would be $28.03. So it's a pretty good discount from the current price. And if you're not assigned, if a month away the price is above $28.5, the person buying your put will not assign you. So you will just keep your $46, and then you can sell another put going forward. And even if you're not assigned, you accumulate this put premium, and eventually, let's say, 6 months down the road, you have collected about $300. So that's $3 a share. So that's your buffer. So even if you buy at that time for, say, $33 per share, your actual cost would be $29 or $30 per share because you have collected the premium, the put premium, along the way. So this is one of the ways you can buy the shares cheaper than it is today. Another way, and this is what I want to talk about, is fighting the FOMO. Okay, and I'll show you. We got to look at the longer duration. So we're looking at 1 year, and I started buying this stock about, actually more than a year ago, but somewhere in this range, like in July. And it was going up, it was going down. I started buying it like $14. Like right now it seems like a crazy good price, but back then the stock within a month basically went from $6 to $12. So it doubled, and buying for $14 back then was kind of scary. But I at some point was shorting the stock, and then I'm like, no, I did some more research. I'm like, this is stupid. This stock is going to grow. They're doing amazing. It's a great company. So I decided to go from short to long, and I started investing in this stock, started buying it, and basically I have shares that are like $14.80, give or take. Anyway, but I was worried. I was getting worried. Like over here, it ran up to $18. I was like, should I buy more? Should I buy more? But then I'm like, okay, put step on the brakes. The stocks don't always go up. Sometimes they go down. And here it dropped to $14.70 again from $18, and that's like a 20% drop. And so this actually happened multiple times. Like over here, in November, it ran up to almost $22, but then it dropped again to 16. And so market gives you these opportunities when people start worrying, people start panicking, something happens over there, and people just get scared, and so the stock drops. And this $33, I believe, it's my firm belief, that we will see $27, $28 range again in the near future. Now, right now it ran up if we go back to 1 month, it ran up in anticipation of September 6th update to S&P 500. Basically, people think that Palantir may get included in S&P, and I don't know if it will or will not. But one of the reasons it ran up right now is because institutional investors are buying in, and individual investors are also piling in part. Well, part of it is because they had great earnings, and the scare of August 5th is behind us, and now everything is up and to the right, and people are FOMOing in. But what if we don't get included into S&P 500? This is a third round of potential inclusion into S&P 500, and so the stock runs up in anticipation of that. The first one was Q1 earnings, so it ran up over here, and then Q2 earnings. No, actually, over here was the Q4 earnings of Q4 of 2023, and you can see stock just skyrocketed from $16 to 24-25 range. But after, I believe there was a S&P rebalance somewhere over here or over here, and people were thinking it's going to get included. It never did. And then in the summer, in like beginning of June, also people were thinking that it's going to get included. But anyway, so the point is that while the stock is hot, maybe it's not the best time to pile into it, because what if it drops to 23? You will be sitting on $10 per share loss at current prices. But and there is a good chance that stock will go down even if it gets included in S&P 500. What if the Fed decides not to cut rate in September because of political pressure, of this, of that, anything? People get scared, another bad jobs report comes out, and unemployment jumps from 4.3 to 4.5 or 4.6. The market will crash, and so will the stock of Palantir. And so, by the way, when this scare happened over here, you can see the stock was trading at like around 29 on July 23rd, and then it kind of dropped and leveled off, and then over here on August 5th it actually didn't drop to 23, it dropped to below 21. So there was a huge drop from this peak. In 5 days it went down about $6. That's almost 30%. So it closed at 23.16, but intraday it was below $21. So if there is a market event, then the share price of the stock, because it's so volatile, can easily drop 20-30% in 1 day or in a couple of days. So my point is, don't FOMO in right now. If you're okay buying this stock at $29, sell a put. Agree to buy 100 shares. Now you have to have cash collateral. That's why I didn't go ahead and didn't sell that put, because I only have $103. That's not enough collateral. You have to have enough collateral to basically buy the shares. So for example, again, we're going to 2020, September 20th, sell put. So if you sell a $2,950 put, you need to have $2,950 in your account, and that gets locked away. You basically have no access to that money until the put expires or is assigned to you. Okay, so you cannot use that money. You have to have that cash, because Robinhood doesn't want you to do naked puts. Anyway, if you're okay owning this stock at like $28.82, that's current break even right now, then go ahead and sell a put. What I'm doing right now is I don't think the stock will continue mooning. It's already had a really big jump. Now it could, guys. We don't know the future, and that's why you can at least go a month out, sell a put, and if you're comfortable owning it, if you get assigned, you have shares at lower price than it is today. Basically, it's like $2.50 lower, and otherwise you keep selling puts, waiting for that better price. And by the way, if the share price goes down, especially if there's like market volatility, then you can sell a lower put. So if this stock right now is $30, then you would probably be selling like a $26 put or a $27 put, and that already gives you a much better cost basis. So yeah, that's how you can own Palantir for less. And even if you don't get your shares over time, first of all, you collect the premium. That the premium that you get for selling a put, that stays with you. It's not going back to the buyer of the put. So that's yours to keep. And eventually, I believe that share price will come down. Maybe not to $23-25 level, but maybe 26, 27, 28. And at that point, you can also sell put for a lower price. and keep collecting the put premiums until you actually get the shares at the price that you want. Or even if it doesn't come down significantly, eventually you'll collect enough put premium to bring down your overall cost basis. Because even if you buy it for 32, but you already collected $3 in premium, $3 per share in premium, so $300 in put premiums, then you basically your cost is much lower. And by the way, like, you can agree to sell a $32 put. Let's say you believe that stock price will keep going up. If you sell a $32 put, you will collect immediately $158 per contract. Now you're required to put up $3,200 as collateral, but you're collecting immediately $158, give or take, probably a little bit more. This is a bid-ask spread right here. It's pretty tight, which is nice. It's only like 4 cents away, so that's $4 per contract either way. But your cost would be actually $3.40, not 32. Not right now, it's 32.30. If you're assigned, you're basically $2 below current price. So that's very nice, and that's how you can secure a better share price. And by the way, guys, going back to the Palantir, their earnings and whatnot. So let's take a look at estimates from the street. So the street is I think the street is underestimating. So over here they were estimating like 630 or 50 million in revenue, and they beat the estimates hands down. Like they were amazing. But see, like, these are the estimates from the analysts, but it's much lower than the 27% that we have right now. So let's say a year from now, okay, so 4 quarters away, they're estimating $742 million. Okay, let's open our calculator. So what did we have here? 687. So, and over here we have 742. So 742 divided by 687, or was it 78? 678. So they're projecting an annual growth of just 9%. This estimate right here, I think, I mean, they haven't had that growth in years, probably never. You can see the 5-year CAGR is almost 31%. That's 5-year revenue growth annualized. So each year their revenue grew by 30.1%, 31%. Let's take a look over here at their revenue. I don't think they ever had a 9% revenue growth, at least being a public company. So I think this is maybe over here quarter on quarter, but year over year it's definitely more than 9%. So this company will most likely perform much better than these analysts are estimating. So that's number one. Number two, I don't think we have seen the effects of AAP bootcamps, because the sales cycle on those is probably much slower than we think. Because think about who goes to these bootcamps. It's the programmers, it's the the senior engineers, but not CIO or CTO, or like not the big shots who spend the money, who make the financial decisions. So first of all, the coders, the guys that run the on the ground, they look at the software that Palantir offers, and they're amazed. But then they have to go back to their boss and convince them to spend like a couple $1 million, and the boss is like, what are we going to get from that? So the sales cycle on that is probably much longer than people thought, and but they actually had some big contracts signed within like 2-3 weeks of an AAP bootcamp, but most of them will come to fruition at a later date. And so I think this revenue will be over here a year from now. The revenue, in my opinion, will be way north of 850, probably closer to $900 million. And $900 million, so 900 divided by 678, that would be a growth rate of 32, almost 33%. And that's quite achievable, guys. And now if they get a 33% increase in revenue, so revenue growth, the PE on this company will go through the roof. And by the way, if we look at their revenue by segment, you can see over here the government is now less than commercial. No, actually, commercial is catching up to government. Revenue over here, it was like, actually, yeah, commercial has always been lower than government. I'm not sure why this is reported here as government revenue 798. It's probably because they received a big contract, but it actually didn't go on the revenue in that quarter, because you can see the revenue right here. Anyway, so the growth of this company is amazing. They actually started doing buybacks. They authorized $1 billion of buybacks. If you look at their cash position, like, it's amazing. Look at that. They basically have no debt and $4 billion in cash, and probably their debt is a lower interest rate than they collect on just parking their cash in treasuries, and so that's why they're keeping the debt that's lower, and they're making more money on just keeping treasuries. And that's just the cash management. I'm not talking about, the company making money like crazy, hand over fist. But basically, I see bright future. This is just a $18 million buyback. I think it's going to be much higher. And yes, they still have a pretty high stock-based compensation, but it's going down. You can see over here, it's trending down. Back here, they were having like $242 million in share stock-based compensation, and now it's 142. So it's down by 100 million. And yes, it's an increase over the last couple of quarters, but it's insignificant, and their free cash flow is growing. Their net income is growing. You can see over here, like, net income is going up and to the right. And so back in the day when this was considered a meme stock, a lot of people were saying like, oh, compare this to Snowflake. So let's take a look at Snowflake versus Palantir. This is our stock compare tool. You can find it right over here, and just type in two stocks over here. You can see the total return on Palantir in less than 4 years is 420%, 240%, my bad, which is much better than S&P 500, and the total return on Snowflake is minus 47%, negative 47%. So, and people who were like in the Snowflake camp, they were like, oh, this is such a great company, look at this. Their EPS loss is going up. The loss is going up. That means they're losing more money each quarter. That's the trajectory going down. PE, I mean, how do you even calculate the PE when you're losing money? That's GAAP. So free cash flow, yeah, but look, take a look at this. Their free cash flow is nowhere near to cover the stock-based compensations. Okay, over here they're on par, but over here they made 100 million free cash flow and spent 300 million on stock-based compensation. Here 300 million stock-based comp and $41 million of free cash flow. And now GAAP revenue has always been negative. They never made any GAAP income, and so yeah, they show a pretty nice growth. But people that kind of work with Snowflake, they're saying that this growth will slow, number one, and number two, Warren Buffett just sold Snowflake, whatever they had, like $250 million, and I believe they sold it at a loss. This company is just not doing well. The stock-based comp is growing. You can see it's only going up, whereas for Palantir, it was really high over here. It's flattened and actually is more or less on a downward trajectory. They're already doing stock buybacks, and they are growing their revenue, their free cash flow, and their GAAP positive. So yes, they will most likely have bumps in the road, but I think long term it's a stock to own. I think they have very bright future. My personal target is at least $100 in the next couple of years, maybe 2.5, but that's a threefold from now. And so one more thing, guys, I want to show you, and that has to do with leap options. So let's take a look at that. So basically, I am actually a big fan of leap options and deep in the money leap options. So for example, in August 23, so basically a year ago, today is August 21st, 24, so this was a year ago, I bought a leap option for this stock. I paid $6.40 for that contract. Now again, keep in mind, I was afraid because the stock just ran up like 100% at the time. So you see current price was right here, the price of Palantir at that time. No, my bad. Whatever, I don't remember what the price was. We can check it out, but basically I bought a $10 call, so that was deep in the money, so I guess it was below $16, and I paid $6.40. So for $640 I secured 100 shares of Palantir. Now my cost at the time was higher than the cost of Palantir shares, that Palantir was trading for. So if we look at 1 year, and yeah, so this is when I bought the option, August 24th, a year ago, and the Palantir was trading for $14.14. So if we go back to here, so my break-even price at the time was $16.40. So that was like $2 higher than the shares were trading. So I could spend $1,400 for 100 shares of Palantir, but I chose to buy a deep in the money call option. So that was $4 below trading price. That's a strike. So right here you can see $10 call. So basically somebody sold me the right to buy their shares of Palantir for $10, and for that they received a premium of $6.40. So at the time they collected about 15% premium, but that was a year and a half out. So the expiration is still in the future. It's not 2025 yet. So the expiration was January 17, 2025, and basically for $6.40 I secured myself right to own the shares at $10. So my break-even price would be $16.40. Now a year later, actually less than a year later, like over here, I exercised that. It doesn't show the date here, but I believe I did it somewhere over here. So no, maybe over here in April. So at the time Palantir was about $23, but my cost was $16.40, and so I bought the stock essentially for about $5 below market price at the time, and that was like 30% gain. So at the time I took this screenshot, my gain was 6. Actually, this is a different screenshot. We're looking at this one. So yeah, my gain on that was 200%. I could just sell the option, but I decided to exercise it because it was very little extrinsic value in this option, maybe like 40, 50 cents. At the time I exercised it, and you know, I would have to pay taxes on $1,200, which is much more than $50 that I lost in extrinsic value. I just exercised it, and my cost for those shares is $16.40. Now later, in when the share prices dropped after Q1 earnings report, so somewhere over here in May, I bought $13 options. Okay, again deep in the money, so about $9 below market price at the time. So let's take a look. I bought it on 3 different occasions. It doesn't show right now, but basically 3 contracts this time, and I paid average cost of $10.62. Right now I'm up 100% on those calls. I still have them, and what I do is this is a poor man's covered calls. I actually sell covered calls on this on these options that I have. So I actually already brought down this cost to about $9 per share, and now my break even is $23.62, but now the shares are trading at $9 higher, and so my return on those calls is 100% right now. I'm looking to keep those contracts until expiration, which is in 26, so a year and a half from now. And so I sold a very far out of the money calls on these option contracts, and I will explain that in a separate video. But basically I collected like $1.50 premium, so that brings my average cost per contract to $9 per share, and my average break even down to $22, give or take. And so if I'm assigned, I sold a $41 or $42 call expiring in January of 25. So if I'm assigned, I am up like 400% on those options, which is great, or 300%. And most likely I hope I will not get assigned, and I will just keep selling far out of the money covered calls. Now if we look at the strategy over here, so let's take a look at January calls. Right now we're 5 months away from January. A $42 call costs, you would receive, if you have 100 shares, you can sell a covered call for $1.71 right now. So you collect a pretty nice premium, and then even if you're exercised, you know, it's a $43.69 right now break-even price, and the current price is $10 below, so you're making 33% in 5 months. I think it's a nice return, but I hope not to get exercised. I hope shares will stay below $42 by the expiration, and then I can sell another cover call. And even if I'm in danger of exercise, I can just roll it further, collect more premium, bringing my cost down. So basically you can right now buy a covered call, or yeah, a long call, so leap. So for example, you can buy a $20 call for $17 right now, and your break even would be much higher than current price. It would be like $5 higher, but you're essentially paying half the price. You're securing 2.5 years, almost 3 years. So you see, this is 850 days away. Do you think that Palantir will not be $37 in 3 years? I think it will be. I think it will be above $37 in almost 3 years, 2.5 years. So that's December 26th. Okay, so you can buy this call. Yes, it's kind of much higher, $5 higher. That's 15% above current price. So over here, 14, almost 15% to break even. However, like, this thing can run 15% in one day on some good news. But even if it doesn't, I think in 2.5 years it will most likely go up by 15%. So for half the cost, you're securing yourself the right to own these shares. And if you are worried about it, what you can do is, at the same time, you can sell, say again, expiring in January, you can sell something like a $43 call. So that will give you $1.50. And so then your actual cost will be $1.50 less. So that would be like $16.25, give or take. So for $16.25 plus $20, that's your break-even cost would be like $36. And you can keep selling those covered calls. That's called poor man's covered calls. You can keep rolling them out. But even if you don't want to deal with that, for that I think you need margin account and all of that good stuff. Now, Roth IRA cannot do margin, at least now, not in my account. I don't know, whatever. The point is that you can secure yourself the right to own the shares for half of the current price, give or take, a little bit more than half. You see, you can do like spend $16.40, so that's half the price, 50% of the cost, and but then your break-even would be much higher. However, I think the shares of Palantir in 2.5 years will probably be around $75 to $100, and so that's my thinking about it. I don't say that you should do it, but the way I see it, you basically pretty much own 100 shares. Yes, your cost is much higher. So over here you can do like a $13 call, but you have to spend right now $2,300. So that gives you the lowest break-even price. So you're only 8% above current share price. Okay, and again, you can sell covered calls on this and recoup some of the money, but your initial investment is higher. However, you basically, let's say you don't have a lot of money right now, but you want to eventually own shares of Palantir, buying deep in the money covered calls, if you believe the stock is going up, gives you that opportunity for, and without putting up a lot of capital up front. Okay, so anyway, that's my strategy. So far it worked. Now it will not always work out, because again, if we look at what happened over here on August 5th, the shares dipped below $21, and so my $13 calls over here, these guys, they were underwater for maybe 5 minutes. Now they're up $3,000. Now this is an older screenshot. You can see the price when I took the screenshot was $28.74 right here. So yeah, that's been a while back. Now it's up $4 times 300. That's another like $1,200. So I'm up more than $3,000 on these calls right now. I'm keeping them, and I'm selling poor man's covered calls against these options, against these leaps. Hopefully I'm not getting assigned. I'll just get to keep the premium and repeat the process. And by the time they expire, now this is not December, this is January 26th. But yeah, anyway, actually we can see what they're worth right now. So this is a $13. This is a $13 call into January. Right here, how much do they cost right now? $21. And I paid for them, I paid $10.62. So I'm up basically by $10 per share. So times 300, that's $3,000. That's how I look at it. Basically, I don't like to spend a lot of money up front, and this gives me an opportunity to secure the shares for much less upfront capital, and to have the option to have those shares later on when they run up. So guys, none of this is a financial advice, but this is how you can own shares of your favorite company for less money. Now you can do this with pretty much most other stocks. This is just a thought exercise of how the mechanics work. So you need level 2 or level 3 option trading in your account for this. There's also a strategy called spreads. Now, because I don't have margin account here, I cannot do spreads. But basically, you can at the same time buy a call. So let's say you buy a $10 call for $24, and you can sell, and that would make your cost $33.40 right here. So $33.40, and that expires in a year from now. I think it's a pretty good deal. I mean, you're only $1 away. Yes, you're putting down like 60%, 66% of the capital that would require you to own 100 shares right now. And you can immediately sell with the spread. You can immediately sell something like a $40 call for $2 right now, and that would make your cost of owning those shares $31 and like 30 cents. And even if you're assigned, you still make about $9 difference. So I think it's a pretty sweet deal. $900 in 5 months, so that would be about 45% return in 5 months, almost 100% annual return. I think it's a pretty sweet deal if you get assigned. If not, you can keep rolling those, but for that you need spreads, and on Robinhood you would need a margin account for that. Now, first of all, warning, don't go crazy on margin. Second, none of this is financial advice. This is just what I do. If shares of Palantir collapse, if they go back to $20, they show you your maximum loss over here. So yeah, don't go crazy buying call options, but that's what I do. And it's a good time to do that when the shares drop in price. It's time to buy calls and sell puts, and when they run up, it's time to sell puts. It's time to sell covered calls. I don't buy puts because they expire, and sometimes the stock just doesn't go down, so it's a waste of money, at least in my opinion. I don't buy puts, I sell puts. I buy leaps long in the future, so 2.5 years is a damn long time, so a lot will happen during that time. We don't know who will be the president. Maybe we'll have a bad recession, and if the shares of Palantir drop back to $20 range, guys, I'll be just buying more leaps, because eventually I believe the stock will do great. You can see it has a really nice growth, and that's my personal belief. I don't tell you to buy that, but that's my analysis, and that's how I secure better price for myself, and how you could do it and generate some extra income along the way. Okay guys, thanks for watching. I know it was long, but please smash that like button if you enjoyed it, and if you lasted this long, subscribe to the channel and come back for more. Now, if you want to try this software, this DRIPCalc Pro visual stock research tool and stock comparison tool, where you compare two stocks side by side, we offer a 2 weeks free trial and also a 25% lifetime discount, which is going away soon. And so catch it while you can. I don't know when we will stop doing the 25% discount, but yeah, you can try this completely free for 14 days. If you don't like it, just cancel, and that's it. So I'll see you in the next video. Peace.